What if I told you the biggest AI boom in history is built on money that doesn't exist? In September 2025, Nvidia announced a $100 billion investment in OpenAI. It sounded like a declaration of technological destiny, until you see how the deal actually works. Nvidia transfers capital to OpenAI, then OpenAI uses that exact money to buy back GPUs from Nvidia. Analysts at New Street Research found that for every $10 billion Nvidia pours in, $35 billion comes back through GPU sales. That's 27% of Nvidia's annual revenue generated by a single circular transaction. Do you see the problem? When a company is effectively financing itself, it's not creating truly new demand, it's juggling a paper mirage. And when the music stops, the illusion collapses. But this scheme isn't limited to one headline deal. Nvidia owns 7% of CoreWeave, a specialized data center operator. That unit spent $7.5 billion on Nvidia chips this year, and Nvidia then agreed to lease $6.3 billion of cloud capacity from CoreWeave. Capacity it cannot resell because all the servers run Nvidia hardware. It's a financial Russian doll, layer upon layer. The same money circles back as growth. Last summer, Nvidia invested $1.3 billion in Lambda, another AI infrastructure company. Lambda used that cash as collateral to borrow funds, purchased Nvidia GPUs, and then leased the identical servers back to Nvidia's cloud division. It's absurd, but in a world of near-zero interest rates and frantic narratives, it feels normal. Have you ever seen a business this intertwined with itself? This is what happens when cheap capital lets companies manufacture their own demand. As long as money is cheap, these circular loops hold. But what happens when borrowing costs double or triple? When central banks shift from printing trillions to draining liquidity overnight, the moment the Fed hikes rates, every levered entity loses its lifeline. This isn't theoretical. It's the flaw at the heart of the AI hype machine. A Ponzi dressed as progress, and history has seen this movie before. To understand how we got here, rewind to the dot-com bubble. In the late 1990s, telecom giants like Nortel and Lucent borrowed billions to build global networks that didn't yet exist. They cross-financed each other, creating a self-reinforcing frenzy. Investors ignored fundamentals, believing build it now, monetize later was foolproof. Then revenues failed to materialize, networks sat idle, and bond coupons went unpaid. Share prices collapsed by over 90%. Investors learned the hard lesson that hype can drive valuations for a time, but only real customers keep the lights on. The same pattern is unfolding today, just with different buzzwords. Flash forward to 2025. The narrative is AI instead of fiber optics. Wall Street calls it the next electricity, the decisive leap in productivity, or the transformative force of our lifetime. But beneath the buzzwords, the dynamic is unchanged. When yields on safe assets vanish, capital hunts yield at any cost, and when everyone bets on tomorrow without demanding returns today, bubbles form and then burst. The only question is when. The flood of cheap money began with the 2008 financial crisis. Banks teetered on collapse, stock markets crumbled, and panic reigned. The Federal Reserve slashed rates to zero and launched quantitative easing, buying over $4 trillion in bonds by 2013. Central banks worldwide followed, the ECB, Bank of Japan, People's Bank of China. Suddenly, cash was everywhere and virtually free. And that's when the game changed for everyone, including you. Because when safe assets pay nothing, investors hunt risk. Your savings account? Worthless. Bonds? A joke. So capital flooded into anything promising returns. Startups, crypto, real estate. The bubble inflated so fast, most people thought it was the new normal. Traditional safe assets offered nothing. US government bonds yielded under 1%, bank deposits hovered near zero, and money market funds paid pennies. Investors chased record returns, pouring into startups, biotech, cryptocurrencies, and special-purpose acquisition companies. Buzzwords like unicorn and blitzscaling took center stage. Companies that burned tens of millions a month were touted as visionaries. Uber lost $31 billion from inception to IPO, yet its valuation climbed to over $100 billion. DoorDash operated at a loss for years before debuting at $60 billion. The mantra was, grow first, monetize later. And with money this cheap, everyone could afford to wait. Profitability became optional. Growth was everything. The party ended in early 2022. Inflation surged. Food, energy, housing costs skyrocketed. Central banks had no choice but to reverse course. The Fed raised rates 10 times in 18 months, driving the federal funds rate from 0 to over 5%, the fastest tightening since the 1980s. The ECB hiked for the first time since 2011. The Bank of England and the Bank of Canada followed suit. Overnight lending costs quadrupled. Credit lines were pulled back. Borrowers who once paid 1% on floating rate debt now face double-digit rates. Boardrooms erupted in crisis meetings. How can we service our debts if borrowing now breaks our models? Bonds trading near par blew out to 20% yields. Margin calls rippled across portfolios. The illusion of free capital evaporated. And suddenly, companies built on cheap money had nowhere to hide. Then, in March 2023, Silicon Valley Bank collapsed in 48 hours. Depositors withdrew $42 billion in a single day, an event unmatched since the Great Depression. SVB's balance sheet was stuffed with long-dated treasuries and mortgage securities bought at zero rates. As yields climbed, those assets fell by half. SVB SVB tried selling $21 billion of those bonds to cover withdrawals, but was forced to offer deep discounts, locking in huge losses. Panic spread to Signature Bank and Silvergate, both of which suffered runs within weeks. Regulators had to guarantee all deposits to stanch the bleeding. Banks tightened lending, venture funds froze new rounds, and startups found their cash taps shut off. The age of easy money was officially over. But SVB was just the first domino. Private equity deals with heavy leverage were re-examined. Borrowers faced margin calls and distressed exchanges. Startups once valued in the billions saw down rounds slashing their valuations by 70 or 80%. In Europe, companies in the Middle East and Africa confronted $500 billion in refinancing needs by mid-2024. Most were zombie firms, earning just enough to cover interest, never profit. 1 in 5 companies across developed markets is a zombie right now. They're not businesses, they're debt machines waiting to implode. Now, as rates rose, refinancing became impossible. Defaults climbed. In Japan, the first rate hike in 17 years triggered wave after wave of bankruptcies among firms that had survived only on ultra-low credit costs. The life support is off, and the bodies are starting to pile up. But here's what most people miss. While some companies collapse, others thrive. Those with genuine cash flow, real customers, and tangible assets. They're scooping up distressed factories, logistics hubs, and energy infrastructure at a discount while the crowd panics. This is how wealth transfers happen. Not gradually, but violently, and those who understand what's happening are positioning themselves to win. Stay tuned, because next we'll explore how central banks around the world are quietly hoarding gold, building new payment systems, and positioning for a de-dollarized era. We'll also see how reshoring manufacturing and energy security are creating entirely new winners. And by the end, you'll know exactly where the smartest money is going in a world where free capital is dead and real value is priceless, because the shift isn't coming, it's already here. While the headlines scream about tech stocks and bank failures, something else is unfolding beneath the surface. Capital isn't disappearing, it's relocating. The collapse of easy money doesn't just kill bad companies, it restructures entire industries. And the people getting rich right now aren't the ones clinging to the old system. They're the ones who understand what happens when cheap money dies and real assets become scarce. Let me show you where the next fortunes are being built, because what you're about to see will change how you think about wealth in the next decade. Start with commercial real estate, an industry most people assume is stable. For decades, office buildings were financed with cheap loans under the assumption that offices would always be full. Landlords borrowed at low rates, locked in long-term leases, and refinanced when the loan matured. But then remote work exploded. Office vacancy hit 13.2% in 2023, a record high. Mall vacancy reached 8.8% as e-commerce devoured brick-and-mortar retail. Property values plunged, yet the debt didn't. Loan-to-value ratio spiked. Lenders found themselves holding properties worth far less than the loans they issued. And now the entire structure is teetering on the edge. Here's the trap. Most commercial real estate loans are interest-only, meaning borrowers pay only the interest each month and refinance the principal when the loan matures. That model works when rates are low and property values rise. But when the Fed hiked rates from 0 to 5%, banks stopped refinancing. Why would a bank offer a new loan at 3% when the property is now worth half what it was? Commercial leases typically run 3 to 5 years, so landlords are racing the clock. If they can't refinance before the lease expires, they'll have to start repaying principal on properties that generate insufficient cash flow. Many will default, and when they do, the ripple effects will be catastrophic. Small regional banks are especially exposed. They hold massive commercial real estate portfolios and haven't marked down losses yet. They're extending loan maturities, hoping property values recover before balance sheets blow up. But in September 2025, commercial mortgage delinquencies surpassed 2008 crisis levels. If values don't rebound, small banks face capital shortfalls that could destabilize the entire banking system. Business owners holding these loans need liquidity buffers now. The survivors will be those who act before the crisis becomes obvious, not those waiting for a miracle. And if you think commercial real estate is bad, wait until you see what's happening in private equity. By the first quarter of 2025, 55% of buyout holdings sat in tight, tapped out, or breached zones of their leverage caps. That means over half of private equity portfolio companies are maxed out on debt. They can't borrow more to grow. They can't invest in operations. They're trapped. When rates were low, private equity firms loaded companies with debt to finance acquisitions. The plan was simple: buy, streamline, refinance at better terms, and exit with a profit. But now refinancing is expensive or impossible. Companies are stuck servicing massive debt loads with no room to maneuver. The model that worked for a decade is now a death sentence. Bankruptcies in private equity-backed firms spiked in the second quarter of 2025. Wellness Pet, owned by Clearlake Capital, completed a distressed debt exchange in June. Nexo Plastics, backed by One Rock Capital, followed suit. Aventive Technologies, owned by Platinum Equity, went through a debt-for-equity recapitalization in April. The common thread is over-leveraged companies crumbling under debt they can't service. Private equity's model of aggressive cost-cutting and financial engineering works brilliantly when money is cheap. When it's expensive, the model breaks. Firms that survive this phase will be those that actually create value, not financial illusions. And here's the wild part. part. The smart money already knows this, but here's the twist nobody talks about. While these companies collapse, capital doesn't disappear. It relocates. Smart money is moving into hard assets, infrastructure, energy, commodities, things with intrinsic value that don't rely on narrative or leverage. Gold is back in the conversation despite years of dismissal. Central banks are buying, institutional investors are hedging, because when fiat currency loses trust and debt becomes unsustainable, tangible assets become the anchor. And here's where the story takes a geopolitical turn that most people aren't watching. China's central bank bought gold for 11 straight months through September 2025. Official holdings sit at around 2,300 tons. But here's the twist. Analysts believe the real number could be triple that. Why? Because China maintains separate accounting systems for gold, deliberately hiding the full picture. They're not preparing for a rainy day. They're preparing for the end of the dollar. Why does this matter? Because China's goal isn't just diversification, it's de-dollarization, and they're building the infrastructure to make it happen, and they're not alone. Central banks globally now hold more gold than US treasuries for the first time in decades. The trend accelerated after Western nations froze $300 billion in Russian reserves following the Ukraine invasion in 2022. That move sent a message to every non-Western government: dollar-denominated assets can be weaponized, so they're moving into gold. Russia, India, Turkey, Poland, Singapore all buying. In August 2025 alone, central banks added 19 tons to global reserves. This isn't speculative trading. This is strategic accumulation by sovereign states preparing for a world where the dollar's dominance fades. And the implications are staggering. In October 2025, Russia hosted the Moscow Financial Forum and unveiled the precious metals exchange, allowing countries to settle payments in gold, platinum, diamonds, and rare earth minerals. No SWIFT, no dollar, no Western financial infrastructure. Countries can trade directly using hard assets as collateral. BRICS nations, Brazil, Russia, India, China, South Africa have been working on a gold-backed payment system for years. Not a full currency replacement for the dollar yet, but a parallel system that bypasses Western control. Russia's President Putin suggested backing it with hard assets. China's been quietly positioning for this by stacking gold. The bloc controls 72% of global rare earth reserves, giving them leverage over supply chains for electronics, batteries, defense systems. They don't need to launch a competing fiat currency. They're building infrastructure to settle trade in commodities and gold, rendering the dollar optional. And that changes everything. Most Western analysts dismiss this as geopolitical theater, but 68% of global trade already bypasses the dollar in some form, the highest percentage since records began. If BRICS successfully operationalizes a gold-backed settlement system, that percentage accelerates. And when that happens, demand for gold doesn't just rise, it explodes, because suddenly gold isn't just a hedge or a store of value. It becomes functional currency infrastructure for international trade. The price implications are massive. Some analysts project gold could hit $4,000 per ounce within 2 years if this system gains traction. Others say $5,000 isn't unrealistic if dollar confidence continues eroding. This is the kind of shift that creates generational wealth for those positioned correctly. Now contrast that with what's happening in manufacturing. For decades, the mantra was offshore everything to cut costs. China became the world's factory. Supply chains stretched across oceans. Then the pandemic hit. Suddenly those supply chains broke. Chips, drugs, electronics, all stuck in ports or unavailable. Companies realized the fragility of relying on distant suppliers. So reshoring started, bringing production back home. The numbers are staggering. Nearly 300,000 jobs returned to the US through reshoring and foreign direct investment in 2023, the second highest year on record. 2 million jobs have come back since 2010. 69% of US manufacturers began reshoring supply chains, and 94% report success. 82% of manufacturers either moved factories back to the US or are in the process. Only 7% aren't discussing it at all. Sounds great, right? Except there's a massive problem. This isn't just about jobs, it's about infrastructure. Factories, warehouses, logistics hubs, energy systems, all of this requires massive capital investment. And here's the kicker. The companies leading this shift aren't startups burning venture cash. They're established manufacturers with real balance sheets and profitability. They're investing in automation, training, supply chain localization. They're building the physical backbone of the next economy. While tech companies implode under debt, industrial firms are hiring and expanding. The valuation gap between tech and industrials has narrowed dramatically. In 2021, tech stocks traded at 30 times earnings, while industrials sat at 15. By mid-2025, tech is down to 22, industrials up to 18. A convergence reflects a market realizing that physical production has value, and narrative-driven tech doesn't without profits. But here's where the story gets really interesting, because there's a catch. Stay with me, because what comes next is the labor crisis nobody saw coming, and the energy bottleneck that will decide who wins the next industrial cycle, and if you're not prepared for it, you're going to get left behind. Reshoring sounds like the perfect answer to supply chain fragility, but there's a bottleneck most people don't see: labor. 2.1 million manufacturing jobs are forecast to go unfilled by 2030, costing the US economy $1 trillion in GDP. If reshoring accelerates, that shortfall hits 3 million. The factories are coming back, but the people aren't. The skills gap is real. Decades of offshoring hollowed out the domestic workforce. Younger generations generations pursued tech careers and finance jobs, not manufacturing. Now companies desperately need welders, machinists, CNC operators, and industrial technicians, and there aren't enough. Trade schools are seeing enrollment spikes, apprenticeship programs are expanding rapidly, wages for skilled trades are rising faster than white-collar jobs in many regions. The old narrative that manufacturing is low-skill, low-wage work is dead. Modern manufacturing is high-tech, high-skill, and increasingly high-pay. But retraining takes time, and time is something the economy doesn't have in abundance. This labor shortage will determine which companies survive and which collapse. Then there's energy. Reshoring requires enormous amounts of power. Manufacturing is energy-intensive. Data centers powering AI consume staggering amounts of electricity. Electric vehicle production needs stable, reliable grids. Renewable infrastructure depends on rare earth minerals, most of which come from China. Energy security is becoming national security. Countries that control energy production and rare earth supply chains will dominate the next industrial cycle. The United States has massive natural gas reserves, but infrastructure to process and distribute it domestically is still catching up. Europe is stuck between Russian gas dependency and renewable transitions that aren't scaling fast enough. China locked down rare earth supply chains decades ago, producing 90% of global supply. Whoever controls energy and rare materials controls manufacturing, and manufacturing determines economic power. This is the bottleneck nobody's talking about, but it will define the winners and losers of the next decade. Here's the pattern emerging. Cheap money created an illusion economy where ideas were valued more than production. Narrative trumped fundamentals. Leverage replaced equity. Hype overshadowed profit. Now money is expensive again, and the market is reallocating capital toward tangible value. Gold, because it's the ultimate reserve asset in a world losing faith in fiat. Manufacturing, because physical goods can't be virtualized or leveraged into oblivion. Energy and commodities, because without them nothing gets built or moved. The winners in this transition are those who saw it coming and positioned early. The losers are those still clinging to the old playbook, chasing narrative over fundamentals, leverage over equity, hype over profit, and the gap between winners and losers is widening every single day. And here's what nobody's saying out loud yet. This restructuring isn't temporary, it's permanent. The era of cheap money isn't coming back, not in our lifetimes. Central banks learned that zero rates create zombie economies. Inflation taught them that printing money has consequences. Geopolitical fragmentation means globalization is reversing. Supply chains are regionalizing. Currency blocks are forming. The world is splitting into spheres of influence where trade happens in local currencies and hard assets, not dollars and debt. The next decade won't look like the last, and the fortunes built in the next decade will be built by those who understand this shift before it's obvious to everyone else. This is the moment where the new wealthy class is being created right now in real time. Let me give you a concrete example. In 2024, investment flows into industrial real estate, warehouses, distribution centers, cold storage hit record highs, while office real estate investment collapsed. Why? Because logistics infrastructure serves e-commerce and reshoring, two irreversible trends. Meanwhile, office towers in San Francisco and New York sit half empty with no buyers in sight. Smart capital is betting on what people need, not what they used to want. The same logic applies to energy. Natural gas pipelines, LNG terminals, nuclear reactors, and grid infrastructure are seeing unprecedented investment, while speculative green tech startups without revenue models are getting slaughtered in the public markets. The divergence couldn't be more clear. Real assets are rising, narratives are dying. Gold's resurgence isn't just about central banks. Retail investors are buying physical gold and silver at rates not seen since 2011. Gold ETFs are seeing inflows again after years of outflows. Why? Because trust in fiat currencies is eroding. The Fed printed trillions, the ECB did the same, and inflation proved that money supply matters. People are hedging against currency debasement, and gold is the oldest, most liquid hedge in history. If BRICS launches a gold-backed settlement system and even a fraction of global trade adopts it, the demand shock will be unprecedented. Gold could become the bridge between the old dollar system and whatever replaces it. And those who accumulate it now, before the crowd realizes what's happening, will be positioned to capture enormous wealth. But let's talk about the elephant in the room. What happens to tech? Not all tech is doomed. Companies with real customers, real revenue, and real profits will survive. Microsoft, Apple, Google, they print cash. But the speculative layer, the companies burning billions on unproven models, the ones relying on perpetual fundraising, they're finished. The Ubers and DoorDashes that finally turned profitable will hold. The next wave of AI startups without clear monetization paths will die. The market is done rewarding potential. It's demanding performance, and that's healthy. Creative destruction clears out the weak and rewards the strong. It's painful, but it's necessary. And when the dust settles, only the companies that create real value will remain standing. Here's the bigger question. Are you positioned for what comes next? Because the transition is already happening. If you're holding a portfolio heavy in speculative tech, ask yourself, do these companies generate cash or do they generate stories? If you own commercial real estate in a declining urban core, are you prepared for a decade of stagnant or falling values? If you're invested in companies with high debt loads and no path to profitability, what's your exit plan? The smart money isn't panicking, it's reallocating into dividend-paying industrials, into commodities, commodity producers, into infrastructure plays, into physical gold and silver, into companies that build, make, and move things in the real world. The reallocation is happening now, and those who act first will capture the most upside. And here's the final twist. The new wealthy class being created right now isn't built on code or apps. It's built on ownership of tangible assets, land, energy, minerals, manufacturing capacity. The people who bought distressed industrial real estate in 2023 and 2024 will be worth fortunes in 2030. The investors who accumulated gold below $2,000 an ounce will look like geniuses if it hits $5,000. The entrepreneurs who invested in reshoring automation and skilled labor will dominate their sectors. This isn't speculation, it's reversion to fundamentals. And fundamentals always win in the long run. History doesn't repeat, but it rhymes, and right now it's rhyming with every major economic shift of the past century. So here's my question for you. Are you still playing by the old rules, chasing narratives and leverage, hoping the Fed bails everyone out again? Or are you positioning for the world that's actually coming? A world where capital is expensive, debt is dangerous, and real assets are king? Drop a comment and tell me, do you think we're headed for a controlled correction or a full system reset? And if you're holding tech stocks right now, are you hedging or are you riding it out? I want to hear what you think, because the next 5 years will separate those who saw this shift coming from those who didn't. And I bet you'd rather be in the first group. The choice is yours, but the window is closing fast. The era of easy money is over. The age of real value has begun, and the fortunes of the next decade belong to those who understand that shift before the crowd does. Thanks for watching. Now go position yourself accordingly.